Let's talk about something that might seem a bit dry at first glance, but I promise you, it's crucial for understanding how businesses work and how they thrive. I'm talking about the balance sheet. Now, before you roll your eyes or think this is going to be a boring lecture, let me assure you that grasping the balance sheet can be a game changer for anyone interested in finance, business, or even just making informed decisions about your own money. So, let's dive in. First off, what is a balance sheet? Think of it as a snapshot of a company's financial health at a specific point in time. It's like a photo taken at a party, capturing all the guests, the decorations, and the vibe at that very moment. The balance sheet summarizes three main components: assets, liabilities, and equity. This is where the magic happens. It gives you a complete picture of what a company owns, what it owes, and what's left for the owners after all the debts are paid. Now, let's break this down a bit further. Assets are the resources that a company controls. These are things like cash, inventory, property, and equipment. They represent potential future economic benefits. In simpler terms, assets are what a business can use to generate revenue. They're listed first on the balance sheet, usually in order of liquidity, meaning how quickly they can be converted into cash. So, cash is at the top, followed by accounts receivable, inventory, and so on. Then we have liabilities. These are the debts that a company owes to outside parties. Think of them as the bills that need to be paid. Liabilities are also categorized into current liabilities, which are due within a year, and long-term liabilities, which are due later. It's essential for a company to manage its liabilities effectively because failing to do so can lead to financial trouble. Now, let's get to equity. This is what's left over after liabilities have been subtracted from assets. It's essentially the owner's claim on the assets of the business. Equity can come from two main sources: contributed capital, which is the money invested by the owners, and retained earnings, which are profits that have been reinvested in the business instead of being paid out as dividends. Equity is crucial because it shows how much value the owners have in the company. So, why is the balance sheet so significant? Well, it helps investors, creditors, and management assess the financial stability of a business. By comparing the current assets to current liabilities, stakeholders can determine the liquidity of the company. Essentially, can it pay its short-term debts? If current assets exceed current liabilities, that's a good sign. But if they don't, it could indicate financial distress. And here's where it gets even more interesting. The balance sheet can reveal trends over time. By comparing balance sheets from different periods, you can see how a company is growing or shrinking. Is it accumulating more assets? Are its liabilities increasing? These insights can help investors make informed decisions about whether to buy, hold, or sell their shares. But let's not forget, the balance sheet has its limitations. It only provides a snapshot at a single point in time, so it doesn't show the full picture of a company's financial health. For example, if a company sells a significant asset right after the balance sheet date, that sale won't be reflected until the next report. Plus, it doesn't provide information about the quality of assets. The company might have a lot of accounts receivable, but if those are unlikely to be collected, that's a red flag. Another limitation is that intangible assets like intellectual property or brand value often don't make it onto the balance sheet. These can be significant contributors to a company's worth, but they're not always captured in the financial statements. Now, let's talk about the importance of understanding the balance sheet for your own financial decisions. Whether you're an entrepreneur, an investor, or just someone trying to get a handle on your personal finances, knowing how to read and analyze a balance sheet can empower you. It allows you to assess the financial health of a business you're considering investing in or even your own financial situation. For instance, if you're thinking about starting a business, creating a balance sheet can help you understand what resources you have and what debts you might incur. It can guide your decisions about how to allocate your resources and manage your liabilities. And if you're an employee, understanding the balance sheet can give you insights into your employer's financial stability, which might affect your job security and growth opportunities. You want to work for a company that's financially sound, right? Now, let's get practical. How do you analyze a balance sheet? One common method is through financial ratios. These ratios can provide insights into a company's efficiency, leverage, liquidity, and return on investment. For example, the current ratio compares current assets to current liabilities to assess liquidity. The ratio above 1 indicates that the company can cover its short-term obligation, while a ratio below 1 raises concerns. Another important ratio is the debt-to-equity ratio, which compares total liabilities to total equity. This helps assess how much leverage a company is using. A high ratio might indicate that a company is taking on too much debt, which could be risky. The asset turnover ratio is another useful measure. It shows how effectively a company is using its assets to generate sales. The higher ratio indicates better efficiency, while a lower ratio may suggest that the company is not utilizing its assets effectively. And let's not forget the quick ratio, also known as the acid test ratio. This measures a company's ability to meet its short-term obligations with its most liquid assets. It's a more stringent test of liquidity compared to the current ratio, as it excludes inventory from current assets. So, whether you're looking to invest in stocks, start your own business, or just want to be more financially literate, understanding the balance sheet is key. It's not just a collection of numbers, it tells a story about a company's financial health, its ability to meet obligations, and its potential for growth. In conclusion, the balance sheet is a vital tool in the world of accounting and finance. It provides a comprehensive overview of a company's financial position, allowing stakeholders to make informed decisions. While it has its limitations, when used in conjunction with other financial statements and analyses, it can offer valuable insights. So, the next time you hear someone mention a balance sheet, don't tune out, embrace it. It's a powerful tool that can help you navigate the complex world of finance and make smarter decisions, whether you're managing your own finances or investing in the next big thing. Understanding the balance sheet is not just for accountants or finance professionals, it's for anyone who wants to take control of their financial future. So let's get to it.